good afternoon to you, Ashi. Thank you so much for joining us in ET Now. And the key question that we are asking all of our participants is the fact that how much more of a selling are we likely to see, or do you think that the end is near now?
Hi, good afternoon. Firstly, thanks so much for having me on the show. So that's really the question on everyone's mind, right? We don't necessarily think we are at the absolute bottom. There could potentially be further downsides, and just to kind of understand that in the overall context, right? Markets have kind of doubled from before pre-COVID levels, right? Not taking the COVID fall, but if you look at the large cap indices, they have doubled from pre-COVID. You're down only 10%. Small caps are up 300%. You're down only about 20%. If you look at the kind of corrections in the context of the immediate move that you've seen on these broader indices, the correction is really not something which is very sharp. Now, if we look into what are the factors driving this current correction, right? You've got a slowdown in both economic growth and clearly in corporate earnings. We've just completed the kind of corporate earnings season. You've had a low single digit kind of earnings growth for the Nifty. You also kind of have a combination of other factors. You have interest rates where the whole interest rate reduction cycle is actually getting delayed. You have uncertainties related to what Trump is doing, especially in terms of trade and tariffs, and also a generally weak rupee. Now, in the context of the fact that there are multiple headwinds to the markets, markets have moved up substantially over the last few years. And the correction is still something which is not something which is very steep in the context of the kind of larger move. We wouldn't be surprised if you could see further downsides to the market. The only thing is, given the very strong strength of the longer term India story, we don't believe you'd see substantial downsides. We are a bit more concerned about small caps. So broadly, if you're just looking at it, I think on the larger cap indices, another 5-10%, and that should pretty much be done. But what we are concerned about is small caps. Because in small caps, if at some point in time the retail investor starts panicking, liquidity can dry up very rapidly, right? And you could see very sharp downsides there. So it is a market where we would advise investors to kind of remain cautious.
Okay, interesting. Ashi wanted to understand whether there are any value zones now, pockets which may have corrected significantly where you think one can start buying into.
So clearly, right, there clearly are quite a few interesting value zones. I'll just give you some of the kind of areas that we are kind of focusing on. Digital is it's a space we've spoken about multiple times in the past. We really see a lot of value in terms of the longer term growth potential of listed digital platforms, both in terms of the ability to scale up not just revenues, but also increase profitability. A number of these counters have actually fallen quite significantly. This is something that it is very important that any investor looking at the space needs to take a properly long-term view, right? We're talking about 3 to 5 years plus. But for anyone with that kind of a time horizon, we're seeing a lot of attractive opportunities in digital. Within BFSI, I think there are a number of banks ranging from some of the high quality franchises that haven't been performing or certain other banks with higher exposures to unsecured or MFI, which have corrected very significantly. Some of these do present some quite attractive buying opportunities. So on that second bucket, in terms of the banks with the MFI unsecured exposure, you probably just want to wait for the dust to settle. Apart from that, there are certain kind of sectors where there is very, very strong business momentum and a very strong longer term kind of story. So these would be kind of companies in capital markets and real estate and capital goods. All of these had run up very considerably. These are also kind of stocks that have led the fall. So they've all kind of fallen more than the kind of overall markets. However, given how sharp the move is, we kind of believe that there could still be some amount of time before these become attractive buying opportunities. But in the context of the longer term growth, for people with a slightly longer term horizon, I think some attractive buying opportunities in these spaces could also emerge.
So some attractive opportunity in the space, especially when you talk about the cap goods space, could emerge. And taking that question forward to you, Kunal. So in the cap goods space, which one looks good to you? But because this particular this particular sector also has not been spared in this sort of a correction.
Yeah, it's not been, and I think many of these stocks, they're down some 30-40%. So, whether you look at L&T, you look at EBV, etc., many of these stocks from their September or 2024 highs, to put it broadly, I think these stocks have fallen by 40%, and these are very rare kind of corrective phases for these stocks, because when stocks like L&T etc., when they fall 40-50% in a span of 6-8 months, that's generally considered to be a very good opportunity to try and look at it from a long-term play. Now, historically also, when we looked at the charts over the last decade and a half for many of these names, there have been many phases when these stocks have corrected by 30-40%, and that's generally been par for course where these stocks come back into good value territories. In some zones there were points where the stocks have come back into deep oversold territories. So I think we are somewhere in the midst of that kind of a price territory for many of these cap good names. I think buying on a staggered quantity at staggered approach at current levels could be a good strategy. And whenever these stocks show the first potential signs of a turnaround, that's where I think one should look to even start allocating a higher allocation of capital.
Okay, that's that on cap goods when it comes to a space. Technology, of course, is the one space which is looking quite good. Ashi, you were just talking about, some spots within the new age tech space. But what about traditional IT services? How does that look in the time of, not just AI, but all that's happening in the US as well?
So IT services definitely does look interesting. You kind of need to bifurcate a bit between a shorter term and a slightly longer term outlook. In terms of the shorter term outlook, there are a number of kind of positives that you are seeing in the space. Firstly, just as in it's one space where the weakness in the rupee clearly does help these companies, right? So weakness in the rupee is clearly positive for margins. So that is one thing. The second core is really there is a large amount of optimism around how Trump could potentially kind of revive the US economy. Now, that is something which will clearly help IT companies. They have all been kind of struggling with weak discretionary demand. We all know these are amongst the highest quality companies in India, not just in terms of corporate governance, but if you look at their financials, you look at the balance sheets, you look at financial ratios, etc. These are very high quality companies that are still available at fairly attractive valuations. Growth has been a concern with the US economy potentially turning around. And with kind of the rupee weakness, you have support in terms of both revenue and margins. AI is going to be a very, very interesting thing to watch. The way we look at kind of the impact of AI on IT services is in the near term, it's actually likely to be a boost. There will be tremendous amount of productivity benefits that IT service companies would be able to kind of extract through the appropriate use of AI. And a number of enterprises will also be looking at kind of adopting generative AI into their business models, and they will need IT firms to help them with that particular transition. It's more from a slightly longer term perspective as AI becomes that much better at coding, that you'd actually have AI possibly being able to replace a certain amount of your coding talent. Now, while this is technically positive at some level for an IT company, right, because you are reducing resource requirements in terms of number of resources, and it's also technically positive for margins, but it could very clearly lead to a deflationary environment over the longer term. So IT services is a space that clearly looks very attractive, looks fairly attractive from a 1 to 3 year perspective. But I think longer term, the impact of AI is something that does need to be closely monitored.
The IT pack for you, which looks good. Apart from IT, then if I will have to ask you about pharma as well, because a similar sort of story playing out if you have to talk about what's happening in the United States, about tariffs, the fact that last week you saw this entire sector actually bear the brunt of the fact that what will happen when you talk about the tariffs or the reciprocal tariffs on the pharma space. Yesterday was pretty okay for this particular sector. Today they are holding on with loss of about 0.5% or so. But what's your take on the pharma sector? Do you think the pain is over, or the sort of negative news flow around the tariffs may be overdone, and it's time to look at the space given the fact that the positives outweigh the negatives?
So when it comes to pharma and tariffs, right, there is a general kind of hope in the markets that pharma would actually be spared. And the biggest reason for the same is that there are very large number of drugs that are still in kind of shortage in the US. A move towards genericization and lower quality, lower price drugs is a very clear requirement in the US. So actually putting on tariffs which should actually increase the cost of drugs is clearly not something that may be a very smart move from a political perspective. So there is some kind of hope that pharma may be spared from very aggressive tariffs. You are also trying to, as part of the Biosecure Act, you are trying to shift production away from China towards other economies. So even if some form of tariffs do come in, we kind of believe that it may be a little more targeted at China. But a lot of this we really have to sit and watch. This will increase uncertainty in the near term, but the kind of hope is that tariffs in the pharma sector specifically may not be that high. However, when it comes to pharma, one important thing to kind of just understand is that there's been one very large drug called Revlimid, which has boosted earnings for a very large number of companies. Now, as the revenues from this particular drug plateaus, it does create a fairly high base for companies to grow off. And therefore, when you're looking at pharma, it's very important to go in stock specific, look at the specific pipeline of new drugs that are kind of going to come in to be able to take care of this high base that Revlimid kind of creates. And therefore, we believe that in pharma, there is the potential for certain earnings downgrades in companies that don't have a strong enough near-term pipeline. And investors just need to be careful about that element.
All right, so that's the take coming in on pharma. When you talk about the fact that what's happening to it fundamentally, how you should actually gauge this entire space. But Naresh, on the charts, a couple of pharma names saw good up move in yesterday's trading session. Case in point being Piramal Pharma, 8% up move in yesterday's trading session. Let's take a look at where Piramal Pharma is in today's trading session. Given the fact that this one has been actually seeing healthy buying of late, 1% downtick coming in for Piramal in today's trading session. But on the charts, which pharma company is looking really good and poised to make a good comeback? And when it makes a comeback, it will be a solid one.
So, for example, if you look at Piramal Pharma, the stock has corrected 40% all from the top. So, bounce back is in play. Names which look very strong is something like a Cipla, which has been sideways for the last 6-8 months. Currently, also holding up. Same is the case with the Sun Pharma, which has consolidated well, or a DV's Lab. So, the whole large cap pharma looks very interesting as a defensive bet.
Large cap pharma and the take coming in there. Just looking at some of the other names, right now. For Persistent, of course, which is a big winner today, there's a JP Morgan note which has come in wherein they've upgraded the stock and maintained their overweight on the stock price with a target price of 7,200, and that indicates a significant upside to the current market price. They're saying that this dip currently that you're seeing, it's a high quality growth compounder describing Persistent. They're saying it's offering a good 30% upside potential from the current levels. They're saying they came up with a new target of $5 billion revenues by FY31, which is implying a very strong 26% CAGR growth over FY27 to 31. That's that on Persistent, of course. That's holding up well. Let's see what OMCs are up to. Remember, we just reported to you exclusively a short while back that perhaps OMCs are likely to get some relief and that the oil ministry is expecting some amount of financial support for OMCs in the second supplementary demand for grants for FY25. OMCs will just come up for you on your screens next. My colleague Prakash just reported that exclusive story, and those stock prices will be up on your screens next. Other than that, we're just looking at ABB, for instance. That stock, of course, is down quite a fair bit from its all-time highs. It's a very cautious note that they have actually talked about, or tone rather, in their conference call. They've talked about as to how the market is stabilizing. The PAT range, margin range will be about 12 to 15%, and currently it was at about almost 15.8. They're saying while they did enjoy better pricing environment in 2024, but the valuations are most expensive amongst the peers. So that really is not auguring well for ABB as we speak right now. That said, some of the other names like Sona Comstar, Phoenix, Naukri, etc. are the ones which are definitely holding out. There's a Berger Paints which has stacked up almost about 1.5% as we speak right now. Bata down about almost 1% right now. But let's see which way some of these consumption names actually head. Ashi, I wanted to understand what your thoughts are on consumption. I know you don't track it perhaps as closely as the IT and the tech pack, but any of the consumer names, not just staples, but the entire range, anything that's looking interesting after the recent sell-off to you?
No, and we definitely do track consumer very closely. We run a tech fund, but we also run a general flexi cap fund, and consumer is an important kind of weight there. I think consumer is basically a segment where you are kind of weighting the kind of overall growth recovery. There are the important part is in the current kind of results season, you have seen certain mixed trends, and there have been certain companies that have actually outperformed on overall growth. Uh, However, consumer is not it's not all segments of consumer that are kind of firing. So I think in the current kind of environment where you are kind of waiting to see an overall consumer recovery, you do need to be quite picky about the specific companies that are being able to grow even in this current environment. We've got investments in Titan, which has consistently been doing very well, and they've continued to perform in the current quarter. You have seen other packs, right? So we do have Nykaa in a digital portfolio that has done fairly well. Britannia is the one, Britannia and ITC within kind of the FMCG pack are the two FMCG companies that we hold along with Jyoti. So those are the three. All of these either are very attractive from a valuation perspective. So both in ITC and Jyoti trade at substantial discount to their peers. And Britannia has actually been holding up quite well in terms of overall growth. They have a very interesting transition towards becoming a packaged foods business, a larger packaged foods business. Very interesting kind of initiatives they're taking in the Hindi heartland to actually be able to grow larger in the space. So consumer clearly is an attractive space. You just have to be kind of careful about the segments you're going into. We do prefer discretionary consumer over non-discretionary or FMCG over the longer term. But that pack is currently a bit weak on growth. As overall urban consumption comes back, we actually see a lot of interesting names out there.
Kunal, what's your observation on charts? Britannia, how's that looking?
Yeah, I think Britannia, HUL was one of the few ones which has actually formed a bottom for itself, at least on the very short-term charts. The stock had stopped falling. Britannia, on the other hand, the stock had seen a rise. I think the all-time highs for the stock was around 6,400 levels, fell down to as much as 4,600, 4,680, and then bounced back again to 5,200 to 50 mark. And now it's back again to sub 5,000 levels, which means that the stock is establishing a range around the 4,600 as a support and 5,200 as a resistance. Maybe I think if the stock gets into a second retest towards the breakout on the upside, just about that 5,000 plus mark, that could be a point where would be encouraged to buy the stock.
Okay, that's that on Britannia and how the charts for that and Unilever are looking. The other stock I want to bring up is also Max Healthcare. UBS has come out with a note on Max and they are upgrading the stock to now a buy from the earlier neutral. They've upped the target price also, doubled it in fact from 610 to now 1200. They're saying that the stock is down almost 13% in the past 2 weeks alone and is throwing up an attractive entry point. Ashi, what within the entire healthcare space and not just hospitals but diagnostics as well, I'm going to throw in here, what's looking interesting to you?
So within kind of healthcare, right, we prefer hospitals to diagnostics. I know in the recent past, diagnostics has also been doing reasonably well. But the reason we kind of do prefer hospitals, even though it clearly is a much more capital intensive business, is that hospitals tend to have a much stronger competitive moat. One would argue that hospitals are much harder to disrupt. What you are kind of seeing in the diagnostic space is there are a number of new kind of entrants coming in. The barriers to entry for someone to enter diagnostics is really not that significant. There have been multiple notes in the past that have really spoken about the very wide price differentials that exist between different diagnostic players. So while diagnostics is clearly a very strong growth opportunity, we kind of believe that there's clear competitive threats, and kind of competitive threats have kind of come in and waned. There was very significant pricing pressure a year back that has since reduced, but it is something that we believe could kind of come back. We also believe that there is clear scope for a smart new age digital first kind of tech disruption in the diagnostic space, and how that will play out in terms of pricing and margins, etc., in diagnostics is something we have been a bit watchful for, and this is why it's largely been a space we've stayed away from. Hospitals, on the other hand, there clearly is underpenetration of hospitals in India as affordability improves because of kind of greater insurance availability, right? Ailments are clearly on the rise. Awareness in terms of treatments are clearly on the rise. you do have a kind of a fairly interesting growth runway where occupancies and ARPUs can both kind of move up. That said, when you look at hospitals, you really need to be careful about what stage of a capex cycle hospitals are in, because whenever they're going through a strong or aggressive capex phase, a new hospital takes about 3 to 5 years to actually break even and start making money. What we've seen in the past is when there is a very aggressive capex phase, these companies don't really perform very well. So we prefer hospitals over diagnostics, and within hospitals, we prefer kind of companies that aren't going through a very aggressive capex in the immediate near term.
Hospitals, when you compare it with diagnostics, that's what Ashi actually prefers. On that note, thank you so much, Ashi, for joining us on the show and give.
If you like this video, then like, share and subscribe to ET Now.